Welcome to the next tightening cycle. It's finally here. We are marching headlong towards the next recession. I'm not going to say Great Depression yet. I don't want to get too ahead of myself, but it's pretty much universally accepted at this point. The next step from here is recession. Interest rates are no longer at zero in America. They're now at brace yourself for this, 1/4%. Now, I know that might sound like a lot by the standards of the last, what's it been, 14 years since 2008, in which for almost that entire period, interest rates have been at zero. It is probably, above that average. But when you look at the rate of inflation, which officially, using the modern calculation for, excuse my hiccups, for the CPI, we're at 7.9%. That is the highest that inflation has been since the great inflation of the 1970s and early 80s. And last time that we were at 7.9% inflation, the Fed funds rate, as Zero Hedge so kindly pointed out, and I'll link to a Zero Hedge article tonight or in the description about today's events and the Fed and what happened in markets. It's a good summary. The Fed funds rate was at 13% the last time that CPI inflation was at 7.9%. And so this 1/4% interest rate hike, it's completely meaningless as far as inflation is concerned. I think that we're past any question about transitory inflation. This is not, because of lockdowns. This is not because of, that. Well, actually, we could say it's part of supply chain issues. There's still certainly supply chain issues in production. I deal with them. Everybody I know in business deals with them. But they're not transitory. They're persistent. These are problems that have been ongoing for the last 2 years, and they're showing no signs of recovering. Everybody's just getting into the rhythm of constantly hiking prices because that's what you have to do, because the cost of inputs is constantly rising. The cost of labor is constantly rising. The labor squeeze is not getting any easier. Employers are not, at least in my area, are not having any more luck finding workers. It's as bad now as it's been, throughout this entire period. And so when you couple that with the shock in the oil supply, 3 million barrels a day of Russian oil potentially being cut off from the entire Western market, because that's, as I've said before, what the U.S. is pushing for right now. It's just America that's not going to be buying Russian oil, but the U.S. is pushing all of Europe to quit buying Russian oil. The supply side of the economy is just not looking good. And so we're going to have inflation. We're going to have more inflation. It's potentially going to get even, rise even more from here. But here's the thing: it's the inflation. It's going to stay above a comfortable level. It's not going to go back. It's not going to go down to zero. It's not going to go negative and give us back and recover. Prices are never going to go back to where they were before. Prices aren't going to fall in goods. It's not like this was transitory. For the last couple of years we had some problems, so prices spiked, but they're going to come back down. They're never coming back down. In fact, they're going to keep going up at an accelerated rate. And so how do you rein that in? Well, if you're the Federal Reserve, you rein that in by raising interest rates above the rate of inflation, so that people can look at the rate of inflation and say, gee, inflation is 7.9%. My cash is losing 7.9% a year. I better go spend that. But if the interest rate is above that, then they can say, hey, you know what? If I save my money, I'm going to make more than inflation. It makes sense to save my money. I can have a positive rate of return then. And then what happens? Magically, inflation drops because people stop spending so much. They stop bidding prices up, and we get back on track. It's that simple. You just need positive real interest rates. But instead, by raising the Fed funds rate by a measly 25 basis points, 1/4%, the Fed is not going to affect inflation in the very least. Nobody's going to all of a sudden say, you know what, I was going to try and spend my entire paycheck at the end of this week to make sure that that it didn't get inflated away. But now that the Fed raised the Fed funds rate by 1/4%, I've decided to save part of my paycheck and not spend so much. I've decided to delay consumption and not buy a new computer this month. I think I'll buy a new computer next year. Nobody's doing that because the Fed raised interest rates by 1/4%. And so if they're not going to affect consumer behavior, they're not going to have an effect on inflation. And because we know raising interest rates 1/4% is certainly not going to have an effect on the supply side of the economy. All the Fed can do is try and influence the demand side. But what did we learn from the Fed raising interest rates the last time? During was it Powell? Did Powell call the rate hikes a mid-cycle adjustment, or did he call the initial rate cuts a mid-cycle adjustment? I can't remember now. It's been so long. But the last time that Powell was raising rates, he got to, I think, 2.25%, and that was it. That is 9 rate hikes. And now the other big news today, the Fed dot plot is pricing in 7 rate hikes for this year, including today's. That's not going to happen. The Fed almost blew up the entire United States. Like, America would have been over a long time ago had the Fed not cut rates back down, had they stopped hiking rates back then. And I'm not saying that's a good thing. I think it's terrible what the Fed did. They kicked the can down the road. Now this problem's much bigger than it was back in 2018, 4 years ago, late 2018, when the Fed, infamously flip-flopped the first time, at least for the first time under Powell. Back then, 2.25% was the most that the market could take. Then we were on the brink of collapse, and Powell flip-flopped, and he was able to, keep all the balls in the air, to use a juggling analogy. And all that's lasted up till now. Stonks have continued to go through the roof. They've they've doubled who knows how many times since 2018. But just like back in 2018, the Fed is going to get to a point where these rate hikes will spark a collapse in asset prices. And the Fed has made it absolutely clear. I've said this has been a running theme. This has been something that I have not changed my tune on for the entire time that I've been, putting out these little daily updates on YouTube and on BitChute and now on Rumble. Going back through all that I think I started January 2019. The one thing I've been consistent on is that the Fed will not tolerate falling asset prices. Now, I hope that changes. I sincerely do. I want that to change, but in the time that I've been at this, which is not very long, it's been a few years, but it's been all for Powell, he has not had any tolerance for a falling stock market. He has no tolerance for a falling bond market. He has no tolerance for a falling housing market. Look at housing prices since Powell has been Fed chair. To the moon and beyond. And so very soon as he sees the effects of his rate hikes on asset prices, the Fed will again flip-flop, and they will cut. In fact, Wall Street's already pricing this in. Depending on what you look at, futures markets are pricing in 2 rate cuts now over the next 3 years, and that number is going to rise. As Zero Hedge puts it, the more hawkish that Powell is in the short term, the more dovish he will be in the long term. And so the tougher the Powell talks now, the more stocks will go up because they're going to anticipate that in the future, he's just going to flip-flop and that much harder. He's going to make that much, swifter of 180, going from being a hawk to a dove. And unfortunately, I think this is 100% true. I don't normally side with Wall Street, but I'm not going to just, I'm not 100%, against everything bet that Wall Street ever makes. Obviously, these guys make a lot of money, so they bet the right way a lot of the time. Whether it's a fair game or not, they know how the game is played. And I think they're making the right bet here. The dot plot, if the Fed thinks that they're going to be hiking rates 6 more times this year, hell yeah, I'd bet against that. But the one thing that you can be absolutely sure of, and I'll give Peter Schiff credit for this because he's been saying this for as long as going all the way back, I guess, to when I first started listening to his podcast semi-regularly. I never listened to every one, but I listened to occasionally. Maybe 2017 is when and I'm sure he's been saying it longer than that, but that's when I first heard him say it, is that when we finally have a problem with inflation, the Fed will never be willing to hike rates enough to actually deal with inflation, because they're going to prioritize asset prices over the rate of inflation, over price stability, and so they just simply won't be able to get rates up high enough to crush inflation, and that's where we're at right here. And that's what, Wall Street is betting. Wall Street is betting right now that Peter Schiff is right. And to be honest, I think that, people give Peter Schiff a lot of crap. Like today, he's trending on Twitter because he made fun of Zelensky for wearing a T-shirt to address Congress. And it's stuff like that I love Peter Schiff for, because he's willing to be a lightning rod and just say things that pisses people off. He's very good at triggering the Bitcoin people. And I don't agree with 100% of his takes by any means. I have my economic differences with Peter Schiff. But I love his spirit. Why did I bring him up again? Because I think he's been one of the best people at reading Powell psychologically, just sort of, at predicting his behavior and saying, how the Fed thinks and what they're going to do. I think he's very, very good at that. And so in this case, we're going to have the Fed and Powell flip-flop before the rate hikes get anywhere near the point of helping inflation. And, to be honest, you probably don't have to get the Fed funds rate over the nominal CPI, 7.9% at this point. You probably don't have to, raise interest rates to like 15% or 13% where they were the last time that CPI was at 7.9%. And that's because the collapse in asset valuations will serve as a brake on consumption, because the wealth effect will dissipate. I think the wealth effect plays a much more significant role now than it did in the great inflation of the 1970s. And that's a blessing. At least it should be, because the lesson here is, we just need to bring stock and housing prices, valuations, back down to historic levels. You don't even need, a real significant decline in them, like below historic levels. You just need a reversion to the mean, and that should correct a lot of this overconsumption. Because at this point, when you have inflation, that means that that the economy is trying to consume more than it produces. And a big part of the reason why people are motivated to consume so much is because they feel wealthy, because their assets, go up year after year. I had a retired guy that I knew, a real jerk, who had some money, of course, all in stocks and other assets or whatever. And he was talking about how, the stock market goes up every year. I could spend, as much money as I ever wanted on anything and buy anything, and I'd still have money left over. Just on the interest, or I shouldn't say interest, just on his annual gains. And this guy, who didn't work, was completely useless. He just sat around all day on his ass, took a nap in the afternoon. He's not alone. There's a lot of people like him in this country, especially, we have this culture of retirement in this country. Retirement is a brand new idea that didn't exist before World War II. And we have an aging population. So you have all these people who are sitting fat and happy on their assets, which continually go up year after year, year over year. The boomers. And actually, I think this guy might have been a Gen Xer. He was pretty young. But anyway, it doesn't matter. There's lots of people like this. They're making all this money. They can go out to dinner 7 nights a week. They can buy a new car every couple of years. They can buy a new boat. They can buy a second and a third house. And they're empowered to do this by asset price appreciation. So you bring those assets back down to earth. We see a reversion to the mean. And really, stocks is all you have to do, because everything else will follow. You think people would be buying so many houses if their stocks weren't doing so well? I guarantee you they would not. And so, unfortunately, Jerome Powell is deathly afraid of the cure for inflation. He is afraid of letting the air out of the stock bubble. He is afraid of letting the air out of the housing bubble. He is afraid of letting the air out of the, we've been calling it the 40-year bear market in bonds. Is it even 40 years anymore? I guess it's 42 years now, because it started in 80 or 81, so I guess it's still around 40 years. But unfortunately, that won't happen if Powell has his way. We're seeing the yield curve invert. What does that mean? That means that it hasn't totally inverted yet, but moving towards inversion means that long-term interest rates are falling and short-term interest rates are rising. Now, eventually, we're going to get to a point where short-term interest rates, and it's already happened, I guess, out to like the 5 to the 10-year. I think that the 10-year is yielding below the 5-year. But where it is right now, it doesn't really matter. You just need to know that it's inverting. And in time, you will see that the highest interest rates are at the short end of the yield curve, and that as you move further out the yield curve, meaning longer maturities, further into the future, interest rates will be falling, which will signal that, yes, the Fed is going to raise rates in the short term, but then they're going to cut. And so the Fed is doing nothing to help us fight inflation. And that's even considering that supposedly the White House is actually encouraging them somewhat to fight inflation, because inflation is so bad that it is costing the White House some credibility. I don't think that the Putin price hike that Twitter was pushing is catching on. I think Bidenflation is a much more universally accepted explanation, and of course it has. I think it's silly dependent on either Biden or Putin, directly. I mean, this is much bigger than politicians. But it is true that Biden decided to renominate Jerome Powell, the ultra dove, to be Fed chair. Or at least somebody in the administration decided that. If they wanted inflation to be brought under control, if they wanted interest rates to rise, they would have nominated somebody else to be Fed chair. So it's hard to have much hope. I mean, at this point, stagflation seems to be the default, the base case, the default assumption. Because, yeah, the Fed's going to raise interest rates enough to bring down our public economy, but maybe not to actually suppress inflation. Interestingly enough, we have seen oil retreat a little bit in the last couple of days, which some people are reading as a bet that the Fed is going to be able to fight inflation because, well, the idea is, okay, the Fed is going to be killing demand in the economy, and so therefore there'll be less demand for oil and, blah, blah. I don't really buy into that at this point. I think that oil's still going to keep moving up because, I don't see how the math works out with oil. So, anyway, with that said, I will see you folks back here tomorrow. I will continue to monitor the situation with the Fed and inflation, but things are not looking good.